There is this conflict of ideas in the investment world. There's on the one hand the people that say that technical analysis is worth nothing, that it's just drawing random lines on charts. And then there's the other camp that says technical analysis might work because maybe there's some kind of self-fulfilling prophecy effect, as in if enough people look at the same kind of charts, then maybe there is somewhat of an agreement in the market that when prices seem to be high, that most people aren't going to buy and rather sell. When prices seem to be low, that people tend to buy and not sell that much. So simply because enough people think about an outcome, then outcome is likely will in the end lead towards that outcome actually happening. Now there's a case to be made that something similar is currently going on with Ethereum. This is the Ethereum chart in US dollars. And we got some headlines in the crypto space that Ethereum has finally hit a new all-time high. But technical analysis says that maybe the air could be getting thin for Ethereum now. And maybe Ethereum suddenly starts to underperform again, despite all the positive news around the ETF inflows and the Ethereum treasury companies. There's always two sides to the story, right? There is the fundamental news and the psychology of the market. But then we've got also other charts. For example, this here. This is the Ethereum dominance, and it shows the exact opposite picture. Using the Ethereum dominance chart, I bought a lot of ETH at the middle of April of this year because we hit the same low that we already saw in September of 2019. So Ethereum dominance simply measures how much of the entire cryptocurrency market cap is currently in ETH, and it tends to trade between 7% on the lower end and 21% on the higher end. And here's a story that this chart shows. We might have potential further upside of 42% outperformance of Ethereum relative to the rest of crypto. Now the main competitor of Ethereum when it just comes to capital flows, when it just comes to demand by traditional Wall Street, is of course Bitcoin. And so this is the relative market cap of Ethereum to Bitcoin. How much more upside do we have over here? If history is any indication, Ethereum could potentially outperform Bitcoin by close to 100% from here. Now this can take form in two shapes. It could either mean that Ethereum is rallying, or it could mean that Bitcoin is losing, or it could mean a combination of both. What this assumes though is that the ratio of Ethereum to Bitcoin should stay stable over time. Bitcoin maximalists would of course disagree. The Michael Saylors of this world rather make the case that Ethereum should be underperforming Bitcoin long term, and that this was just the beginning, this 50% drop starting 8 years ago. Now most altcoins actually do not get traded directly versus the US dollar. They get traded versus Ethereum. So there's a concept called liquidity pools. When we buy an altcoin, we swap it versus Ethereum. So there's a capital pool with Ethereum on the one side, altcoin on the other side. And so whenever an altcoin is purchased, the ratio between those two assets change. Thus, there is a direct coupling when we measure in US dollars between the Ethereum price and the altcoin price. And so the extent of the swapping activity between Ethereum and the altcoins can be seen in this chart. This is the Ethereum market cap relative to the others market cap. So this is everything but the top 10 cryptocurrencies. This tends to bottom out at around 0.9. So that means Ethereum has less market cap than all of those smaller altcoins. And it tends to top out at around 2. So that's when Ethereum is double the size of the smaller altcoins. And there was also another top at 2.5. And so what's the upside here? Maybe 8%, maybe 33%. So the altcoins relative to Ethereum seem to be rather cheap. The question is again, is this just Ethereum being extremely expensive now? Or is this a potential altcoin rally? Something has to give. Either Ethereum is going down or the altcoins are going up. Now, this trading range has been quite reliable in the past. The problem is that it does not consider the stablecoin market cap. The stablecoin market cap is included in the others metric. But it's probably better to exclude it. And that's in this chart. This is the Ethereum market cap relative to the altcoins, except Bitcoin, Ethereum, and the stablecoins. Again, we've got somewhat of a constant range. And here we've got outperformance potentially of Ethereum of another 55%. The stablecoins really matter because over time their market cap increases quite consistently. Have a look at this. This is the stablecoin market cap over time. And since the beginning of October of 2023, this is going up. up. So this is now measuring how much DAI and Tether and USDC is currently in the market, and this more than doubled since October 2023. And again, it continues to now go up quite consistently. Now this is the market cap, but does it make sense to look at that market cap relative to all of crypto? I think the answer is yes, because when the stablecoin dominance is very high, so when a lot of the cryptocurrency market cap is currently in stablecoins, that means that the market is rather fearful, or there's a lot of dry powder on the side that's not deployed. Whenever, however, the stablecoin dominance is very low, that means that a lot of the capital has already been deployed, and it's very hard for crypto prices to continue to rise. And so what we see at the top here is the stablecoin dominance. It peaked at around 20%, but in the last 2 years, we tend to trade in a range. That range is between 5 and 9%. And what we see here at the bottom, that's the Ethereum price. Now have a look at how this is moving in the exact opposite directions. When the stablecoin dominance is high, that's when the Ethereum price is low. When the stablecoin dominance is low, that's when the Ethereum price is high. And so this is a quite nice measure to figure out how heated is the crypto market right now. If the stablecoin dominance is low, we might consider selling, for example, over here or over here. And when the stablecoin dominance is high, we might consider buying. So for example, over here and here and here. Now, since the middle of April of this year, this is coming down. In the middle of April of this year was also when the Ethereum dominance was very low. And so this chart would present a potential profit-taking opportunity, as in once we hit the 5% in the stablecoin dominance again, maybe Ethereum will yet again see a local top, and maybe a drop of more than 60% is possible, or in this case, it was 45%. I don't think that the US dollar chart of Ethereum is showing the entire story. I don't think that we will just bounce from this top and see the sell-off. But over time, the market is definitely getting more heated, and we're definitely above the long-term equilibrium. Many charts suggest further upside for Ethereum. A flippening with Bitcoin in terms of market cap is very unlikely. That would be over here. But the current momentum is positive, and there's still some potential way to go further. But it's important to keep a tight stop loss, because at any point we could still turn around. This is just riding the current trend. This is not Ethereum being historically cheap. When the market is mainly deployed, when all the stable coins are already in Bitcoin, Ethereum and the altcoins, that's probably also a good time to take some chips off the table. I've already moved the majority of my Ethereum into Bitcoin and Solana. And while this might have been a bit too early, I'm okay with that situation, because as a tendency, I want to be rather risk off when we are low on the stablecoin dominance and risk on when we are high on the stablecoin dominance. And when we bet on the current trend, we just bet on the momentum to continue. That's, of course, a risk-on proposition. Now, wherever there are patterns in price movement, there's a potential opportunity. A lot of people say that it's just random, that there's only luck involved in trading and in active investing. But really, once we have repeatable patterns, it's not. So let's look at this fundamental pattern. This is Dogecoin as an example. Very often, we see prices shooting up extremely quickly to then deflate over a very, very long time afterwards. So for whatever reason, the price moving up happens much faster than the price moving down. We see this in Dogecoin. We also see this in Floki Ino, right? Just have a look at how quick this rally happened and then how long it took to deflate again. And it doesn't just happen with meme coins, right? This is XRP. It went up quickly to then subsequently deflate for a very long time. Or here, right? The rally happened just in a matter of a few days. A secondary rally happened, but then again, the deflation took a long, long time. So there is obviously some kind of pattern here. And this is across the entire crypto space. And there is a fundamental reason for that. I believe that reason is attention. People say that we live in an attention economy and that attention equals money. And for crypto, that's exactly the case as well. As there is more attention on an asset, the price tends to go up. Now, why does it go up much faster than it tends to go down? Because usually there's some kind of event that happens that brings all the attention on an asset. So people read the news and they wonder, should I buy TON now? Should I buy XRP now? Should I buy YZY? Whatever it is, right? There's always some something going on, and attention means potential purchases. There's also influencers that talk potentially about small cryptocurrencies that then bring a lot of purchase orders with it, right? When thousands of people watch a certain video on a small altcoin, then of course this has some implication on the price. And so we've got this overall capital pool that tends to grow over time, right? Crypto is still a growing market, but within that capital pool, it tends to concentrate towards a few assets at different points in time. Once there is attention on an asset, the price goes up, but then if there's no new news, then the attention tends to fizzle down and tends to go to the other assets. So it's a bit of a game of whack-a-mole, right? There's asset A that gets pumped up, then it's asset B, etc. And so this is where most people lose, right? Most people try to find the needle in the haystack, the 1, 2, 3, 4, 5 altcoins that made the multiple X returns, while the vast majority tends to go down. How likely is it that when you're buying the next recommended altcoin, that's going to be the next KeyCat or the next Dog in Me or the next GP token? The likelihood is rather low. You're probably ending up rather with Coq.ino or with Memecoin or with the Apex token. If you're really honest with yourself, when you look at your altcoin trading and you compare that performance not to the US dollar, but relative to just the buying and holding Bitcoin, Ethereum and Solana, how much did you actually outperform with the active trading? Very likely you underperformed. And again, this is because this is a rigged game. There are a few people that influence the market, that push up prices, and then over time those prices deflate again. I'm doing the exact opposite. I'm trying to find the tokens that got hyped, but where then that hype is dying down, where we're already in the deflation. And then I bet on relative valuations that those kind of assets continue to do worse than Bitcoin, Ethereum and Solana. So while the vast majority of retail investors, they just buy what the influencer has shilled, what the influencer is promoting, where the influencer potentially even got money to promote it, I do the exact opposite. I bet on falling prices at that time. So let's say Elon Musk tweets about Dogecoin again, Dogecoin pumps up, the retail investor gets in. That's when I put this on my watch list. And I'm looking at what point in time is it starting to deflate. And I bet on falling prices over here. Just have a look at what I shared on February 14th. I'm entering a Dogecoin relative to Bitcoin short position. Then 1 month later, I sold it. And that was because Dogecoin underperformed Bitcoin at that point by 32%. So that's what you want, right? You want underperformance when you bet on falling prices. There are a few details to this strategy, but it is a long-term winning approach. Just have a look at a few trades that our community has done. Now, I've actually opened a capital pool where the community members, the premium community members of this channel were able to pay in. This capital pool, unfortunately, has already been closed because we have hit our maximum deposit limit. We are still trading with this until end of the year. I will continue to share the performance here, but it just shows how constantly we can make money by doing the opposite of what most other people are doing. This is 1.5 months. The maximum drawdown from top to bottom was only 2.6%, and we are already at an annualized return of 78%. Before running this capital pool, I've done this approach myself on my own capital, and that's the return over the last 4 years. So this is just a chart from Excel. This is monthly data. Had I just dollar cost averaged into Bitcoin, I would have gotten the return here marked at this gray line. But because I also did shorts on very poorly performing altcoins, I got the return indicated here in black. And I know it can be a bit daunting at first, doing something completely different, going long one asset, going short another asset, doing an entirely different approach compared to just buying an altcoin, just following an influencer that promises you the next 10 or 100x. I know this is a different mindset, but again, we have to do the opposite of what most other people are doing. I created some tutorials to make this as easy as possible. If you want to keep it brief and you're busy, you just have to watch 2 videos. How to use perpetual futures on Hyperliquid and how to do risk management with relative valuation bets on Hyperliquid. It's only those 2 videos and they are in total just 1 hour in length roughly. After you have watched those 2 videos and you've joined the community, I will then send to you my favorite trade. Now that favorite relative valuation trade tends to go up quite consistently, and I've got a strong conviction that it will continue to do so. And because of that, if you enter that particular trade and you do not make money after 1 month of holding this trade, I will refund you 100%, no questions asked. I refund you for the premium membership. The monthly rate is currently $125 US. You can either pay via credit card, or if you want to pay in crypto, you can do that as well. For crypto payment though, the minimum duration is 3 months. But again, after 1 month, if you don't make money with that trade, I will just refund you. You can watch all the videos basically for free. And it's not just about the videos, it's also about the trades that I share in real time, where you can basically manually copy trade what's currently being done with the capital pool. Yes, the capital pool is currently closed, but if you join the annual membership, you will get the chance for early access to the next pool that will start at the beginning of next year. So if you don't want to invest the time, you instead just want to invest the capital, let this run for you. Then with the annual membership, you will get that offer first to join before the deposit limit is hit. A link to premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.